Most people think climate change becomes real when something dramatic happens. A wildfire on the horizon, floodwater in the street, a hurricane on the radar. But for many families, it shows up in a much quieter way. It arrives in the mail. A notice that your insurance premium has doubled, or that your deductible has changed, or that your company is no longer renewing policies in your area. No storm, no flames, just math. Today, we're looking at what happens when the math breaks. We'll talk about why insurers are pulling back in parts of Florida and California, how risk models differ from weather forecasts, and why a 30-year mortgage is really a 30-year bet on future climate conditions. And even if you live in Nebraska, far from rising seas or wildfire zones, we'll explore why climate change risk doesn't stay local in a connected financial system. Welcome back to the podcast. I'm Dr. Mack, and this is the Climate Translation. Most weeks on this podcast, I translate the physical science of climate change. We talk about ocean currents, carbon cycles, atmospheric physics, the how behind the warming. But climate change doesn't just show up in thermometers or satellite data. It also shows up in systems that most of us interact with on a daily basis. Insurance is one of those systems. You may never calculate radiative forcing at your kitchen table, but you do notice when your monthly bill changes. You notice when your deductible increases. You notice when your insurer sends a letter saying they're no longer writing policies in your area. That's why this conversation matters, because when we talk about climate risk, we often focus on the physical side, rising seas, stronger storms, longer fire seasons. But there's another layer, how markets respond to those risks. Insurance is one of the earliest signals that something in the math has shifted. Not because insurers are political, not because they're trying to make a statement, but because their entire business model depends on calculating probability. And when probability changes, prices change. So this episode isn't about taking sides on a policy debate. It's about understanding what happens when the assumptions behind decades of financial modeling begins to move. So that brings us to a question I've heard a lot lately. I don't live on the coast. I don't live in a wildfire zone. So why did my insurance bill go up 20% this year? And it's a fair question. The answer is because insurance doesn't just price the risk on your street, it prices the risk across the entire pool of customers. Insurance works by spreading risk. Thousands, sometimes millions of policyholders pay into the same system. The idea is simple. Not everyone experiences a disaster at the same time. But here's where climate change enters the math. Risk has two parts. The physical risk is the event itself, the hurricane, the hailstorm, the wildfire. Financial risk is the probability of that event multiplied by the cost to rebuild. For decades, insurers relied on a powerful assumption about stationarity, the idea that the past is a reliable guide to the future. If a region has experienced one major flood every 50 years, the model assumed roughly the same pattern going forward. But in many places, the frequency and severity of extreme events are shifting. Warmer oceans can fuel stronger storms. Warmer air holds more moisture, increasing heavy rainfall. Longer droughts intensify wildfire risk, and rebuilding costs have surged. So even if your town hasn't flooded, the overall pool of risk has changed. And when the pool changes, everyone's math changes. Imagine you and 1,000 people are pitching in to cover medical bills for whoever gets sick. If 3 people get sick each year, that contribution stays manageable. But what if 100 people get sick, and then the hospital charges double? Everyone's share has to go up. It doesn't matter if you personally feel healthy, the system has to adjust. That's what's happening in parts of the insurance market, not because the temperature graph has moved a tiny bit, but because the cost curves and the probability curves are moving faster than they used to. And when the assumptions behind the math change, premiums follow. So if insurance isn't just reacting to last year's storm, how are these decisions actually made? This is where risk modeling comes in. Insurance companies and banks aren't looking at a weather forecast for next Tuesday. They're looking decades ahead. To do that, they use something called a catastrophe model, often shortened to a CAT model. A CAT model combines historical disaster data, engineering information about buildings, and increasingly climate change projections. Think of it less like a crystal ball and more like running thousands of stress tests. Engineers build a digital representation of a region, the types of homes, the construction materials, the elevation, the vegetation, the distance from water. Then they simulate thousands of possible future events. Not just one hurricane, thousands of hurricanes. Not just one wildfire, thousands of possible ignition and wind scenarios. From those simulations, they create probability curves, and those curves estimate how often losses of a certain size might occur. Here's how I would explain this in my classroom. Imagine you're rolling a dice, and you're asked, if I roll this dice 10,000 times, how often will it land on the 1 side? But then, what happens if you load that dice, or the dice changes? Climate change doesn't guarantee disasters every year, but in some regions, it increases the probability of certain extremes. It loads the dice. You can have stronger rainfall events, more intense wildfire conditions, faster hurricane intensification. That changes the distribution of outcomes. Now, there's another layer most homeowners never see: reinsurance. Reinsurance is insurance for insurance companies. Local insurers spread the risk across customers, but if the disaster is large enough, they rely on a global reinsurance firm to absorb part of the loss. When reinsurers are seeing volatility in disaster losses, whether from climate factors, development in risky areas, or rising rebuilding costs, they adjust the price they charge insurers. And when the wholesale risk price rises, retail premiums follow. In recent years, some major insurers have reduced new policies in parts of Florida and California. That wasn't a weather forecast decision. It reflected modeling that suggested projected losses combined with regulatory limits on pricing created unsustainable risk. It wasn't politics. It was the probability distributions shifting. When the projected losses over 30 years increase, the financial math adjusts, even if the physical disaster hasn't happened yet. And that's where climate science intersects with everyday economics. Because once the insurance math tightens, it doesn't stop with premiums. It moves into lending. And that's where the ripple spreads far beyond coastlines. Now, for those listeners in Nebraska, Ohio, or even northern Georgia, places that may feel far removed from rising seas or wildfire headlines, let's talk about the 30-year mortgage. When a bank lends you money to buy a home, it's not approving a transaction, it's evaluating long-term risk. In the United States, a typical mortgage lasts 30 years. That means the lender is making an assumption that the property will remain insurable, habitable, and valuable for decades. But here's something most people don't realize. Most banks don't hold that mortgage for 30 years. They bundle it with thousands of others and sell those loans onto a secondary market, often to entities in the U.S. called Fannie Mae or Freddie Mac. Those organizations keep the housing market liquid by buying and guaranteeing mortgages. And increasingly, they, along with private investors, are asking a new question. How exposed are we, and these properties, to long-term climate risk? If insurance becomes significantly more expensive or harder to obtain in a region, lending conditions tighten. Not instantly and not everywhere, but gradually. Lenders typically require insurance. If insurance costs rise sharply, monthly payments rise. If coverage options shrink, underwriting standards may adjust. And when borrowing becomes more expensive or difficult, property demand can change. It doesn't collapse a city overnight, but it can mean that appreciation slows, or certain neighborhoods face higher financing costs than others. In some coastal cities like Miami, researchers have observed shifting demand towards higher elevation areas. That pattern, sometimes called climate-driven migration within cities, reflects how risk perception can influence housing markets. But let's look back at the American heartland, to someone who lives in Kansas, for instance. Even if your town isn't facing sea level rise, you're part of a national financial system. Pension funds, retirement accounts, and mutual funds invest in mortgage-backed securities, bundles of home loans from across the country. If climate-related losses increase in one region, the costs don't stay isolated. They're absorbed by insurers, reinsurers, investors, and taxpayers. At the local level, property taxes fund schools, fire departments, and infrastructure. If insurance costs rise in drought-prone farming regions, or hail damage becomes more frequent in the plains, that affects budgets too. A 30-year mortgage is, in part, a bet on stability. And for much of the 20th century, climate variability has been treated as a relatively stable background condition. In some regions, that background risk is shifting. It's not collapsing or exploding, but it's definitely shifting enough that financial models are being recalibrated. And when the math changes at scale, that ripple effect extends far beyond the original hazard. We've seen how insurance responds to shifting probabilities. We've seen how lending depends on insurance. But let's talk about what happens when the adjustments start to scale. In your house, a circuit breaker is a safety device. If too much current flows through a system, the breaker trips to prevent damage. In financial systems, something similar happens. Not as a dramatic shutdown, but as a tightening. When projected losses rise beyond what can reasonably be covered by premiums, reserves, or public backstops, price increase, coverage narrows, or exposure is reduced. That adjustment is the system protecting itself. In some states, governments have tried to cushion that adjustment. Florida's Citizen Property Insurance Corporation, for example, was created as an insurer of last resort. It provides coverage when private options are limited. Over time, as private insurance reduced exposure in high-risk regions, enrollment in Citizens grew significantly. That doesn't mean collapse is imminent, but it does mean the risk is being concentrated into publicly backed pools, and when risk is pooled publicly, losses are distributed more broadly, sometimes through assessments and higher premiums across the system. And here's the climate connection. Insurance companies don't make decisions based on political debates. They make decisions based on loss data and forward-thinking risk models. If wildfire seasons lengthen, if rainfall events intensify, if rebuilding costs climb after repeated disasters, their actuarial tables adjust, regardless of any rhetoric. The physical climate signal shows up first in loss records and then in pricing. Paradise, California is one example of how that played out. After the Camp Fire in 2018, rebuilding was physically possible, but insurability became more difficult, and when insurance becomes expensive or limited, financing becomes complex. That doesn't end a town overnight, but it does change who can rebuild, how fast, and at what cost. This is what I meant by an economic breaker. It's not a sudden shutdown, but it's a recalibration. For decades, much of our infrastructure and financial planning assumed that historical climate patterns would be stable. Now, in some regions, the baseline is shifting. When physical risk increases, the financial system doesn't debate it, it prices it. And that's the quiet but powerful signal. Even if governments minimize or dismiss climate projections, even if public opinion remains divided, the insurance market responds to observed losses and model probabilities. That response can be gradual, it can be uneven, it can be politically uncomfortable, but it reflects a reality. Climate change is not just measured in degrees Celsius, it's measured in loss ratios. And when those ratios move, the math moves with them. Climate change doesn't just show up in satellite images and temperature graphs. It shows up in insurance premiums, in lending standards, and in budgets. The next time someone says climate change is a future problem or a coastal problem, you don't have to argue about sea level rise. You can ask a simple question. Has the cost of the risk changed where you live? The financial system is often one of the first places that long-term physical trends become visible. And it's not because it's political. It's not because it's ideological. It's because risk has a connection to dollars and cents. When probabilities shift, the pricing shifts. Understanding that shift doesn't have to be frightening. It just means recognizing that climate is no longer just a fixed background condition. It's a variable in an equation. And the sooner we account for that variable, the more options we have. I'm Dr. Mack, and this has been The Climate Translation. If you have a question about the climate that you've been too afraid to ask, or if you have a differing opinion, please let me know. I can use your viewpoints in future episodes. You can reach me at theclimatetranslation@gmail.com. I'll see you next time.